Silver Dave here. It's been a crazy week. I think last week we saw some interesting price movements in the price of silver, and there's been quite a lot of news about people on Reddit saying that they want to squeeze silver. And I would like to give you my opinion on what I think about it and how realistic or unrealistic it is, right? So let's find out. A central element of the silver trade is the futures contract. And a lot of people online have been saying that, they want to squeeze the shorters of silver and gold and other metals. And they're saying that, it's the banks who are shorting the metals, and we can squeeze them. If you understand a little bit of what's the purpose of a futures contract, it's a little bit different from your typical options contract on the stock exchange. And you have to also understand that the market is very different from the stock exchange. You're dealing with physical commodities, not securities. So who is the short seller? The starting short seller in a physical commodities transactions related to a futures contract? Well, the starting short seller and the person who sells first short, right, is the miners. And you're wondering, why are miners selling, futures contracts, and why are they shorting, silver or gold? Don't they want the price of silver or gold to just go up and suddenly they make a lot of profit? You're like, yes and no. Large-scale mining operations have a lot of costs, and they have costs that are related to oil, related to people's salaries. They have labor, they've got royalty costs for mining on the land, they've got fees associated with the land, maybe some pollution taxes. They have material costs, they have refineries to run, they've got machinery to operate, they have machinery to replace, they've got tools to replace. And it costs them also time. The problem is, when, let's say you have all of this, you buy all of this, and today you look at the price of silver and it's $30. You're like, okay, I can mine 1,000 ounces, and the cost to mine 1,000 ounces is $25. And I can make a $5 margin on that if I go into this mining operation. Cool. So you decide you go into this mining operation. And let's say you don't have futures contract, you're just going in, you buy your stuff, your materials, and you mine all the silver. And then after let's say after some time, 3 weeks, you're like, okay, I've got my 1,000 ounces of silver, I'm gonna sell it. Now, because of different market conditions, maybe there was, maybe other miners also decided that it was a good time to start mining. They also are selling silver and they were a little bit faster than you. Silver drops to $20. Now you're screwed. Now you're really screwed, right? You've exposed yourself to a huge amount of risk, and basically you're going to make a huge loss on your operation. That means that you're going to make $5 loss per ounce of silver if you sell. Do you decide to hold on to it? No, you can't hold on to it because you still have your running costs. You got people to pay, and you probably have a lease on your equipment. So you've got interest rates to pay, and you still have royalties. They don't care. You have a contract with them. They're still going to ask you to pay for the contract. And if you bought oil, you may have took out loans to buy fuel to run all this machinery and all your operation. You're in debt, and it's not a good thing. So no. So why do futures contracts exist? Well, futures contracts exist for miners so that they can fix a price, right, in the future, where they can sell their gold or silver at a fixed price. Now, let's say we take this case with this miner again, and he decides that, look, today the price of silver is $30, and I don't know, it's profitable at $30. I can mine it at $25 per ounce as a cost on average for 1,000 ounces of silver. But I don't know where silver will go. It could go up, it could go down, but I don't want to be exposed to risk. I will take my $3,000 profit. It's the safest thing to do. It's the most reasonable thing to do, and I can pay off all my debt. I won't get into any trouble, and I walk away for $3,000 for a week of work. That's pretty good. So what does he do? He enters a $28 futures contract. He will deliver silver, right, at a future date for $28. So he's pushed the price of actually silver down in this case. But for him, it's great because he can mine, he can bring to market the commodity. On the other end, you might have, he makes his contract, he contacts his, basically his exchange dealer, and he tells them, look, can you set up this contract for me and find me a end buyer for my silver? And he's like, yeah, sure, we'll go take you on exchange, we'll auction off your contract, and then we'll see who buys. And then he takes the contract, he's like, okay, we're on the exchange, we're selling the contract, there's 1,000 ounces of silver for $28, that's the bottom line he wants, who wants to bid on it? And then you have maybe on the other side, a dealer broker who's like, okay, it's a decent $28 contract. It's slightly under today's spot price of 30. I'm gonna bid on this. And then we get the contract. He gets the contract. He got it maybe for like $29. So he has, let's take this. We're gonna copy paste it. He got it for like $29, And our banker here, who's on exchange, the broker, he made a $1 spread. He's really happy about it. And our dealer broker, who basically sells to the end client, you, me, who stack silver, is buying silver at $29 through that futures contract. When the contract goes into expiry, the miner is like, okay, I am delivering my silver. He delivers his silver to the exchange. The exchange is like, okay, your contract is settled. Dealer broker, do you want to settle cash or whatever? And he's like, no, I want delivery. He takes delivery of the silver, and then he sells it to his people who pre-ordered silver from him on that week. And this is I would say, the basics of how futures contracts work and why futures contracts exist. Of course, during this process, the auction process and everything, the banker could manipulate the price of silver on the contracts, right? Try to push the contract's price slightly up, so the dealer broker in the end, he auctions in and buys a contract at a slightly higher price. But usually it's not such a big difference. It will not go above basically I would say the current spot price. There is, I would say, he could try to bend it like a few dollars up to make sure that he gets a bigger spread when he sells a contract, the banks, but they're acting in the interest of the miners that they have an end client to buy their metal. And you have to remember that the clients of these bankers are not you, me, are not the dealer broker buying that contract. It's the miners, right? That's really their client. The miners are not just an individual guy owning a mine. The miners are the commodity houses of the world. That's their biggest clients. You just have to Google largest trillion dollar commodity houses. They don't just trade metals. They trade oil, energy, foods, and also metals. And they own refineries. They own a lot of different upstream and downstream facilities. And just Google them and you'll see who they are. And I don't need to go into detail about them. It's publicly known. So what happens next? Well, when you try to say that you want to buy a silver ETF to squeeze silver, basically the dealer broker could also be a silver ETF, and he's buying silver to back up his silver trust. He will buy these contracts and he will take delivery to a certain extent. You are simply buying production of silver. And the issue with that is if the price, let's say today is $28, right? And let's say the first miner, we'll call him Miner Joe, he can mine profitably at $28. there's miner Jane who can mine profitably at $31, $32, right? If it goes above $35, miner Jane will also create a futures contract, and he will still like provide extra supply and push the price down slightly. Miner Joe might also decide, oh, I can mine even more silver. So the supply of silver really isn't squeezed in that case by simply increasing the price, that is the end price that the dealer broker is paying for his silver. If you really want to squeeze, like create a short squeeze, a supply side short squeeze on the silver supply to push the price of basically deliveries up and push the price of silver up, the spot price according to the futures contract, what you need to do is increase the price of the inputs, right? So what happened? In what cases do we see this? Well, you do sometimes see that the price of commodities, metals, for example, precious metals, increase when large mines have strikes. This is something that could push the price up. If you go to like, I don't know, if you're in a country that has a lot of strikes and is pushing the price of, and they are probably like a major producer of gold or silver, the price of silver will shoot up, because then at that point, no seller of silver will sell below $25 because they can't mine it profitably. The other guys will go out of business. So you will only have contracts above a certain point. And that's how you create a supply side squeeze. The other way you could do it is increase the price of oil. That's also really hard. How are you going to increase the price of oil? That's geopolitical. Are you going to go negotiate with Russia for them to stop production of oil? You could also increase the cost of land. Land typically tends to go up over time anyways, because it's a limited resource. There's only so much land that you can mine on, and there's also pollution taxes and so on. So that's limited. Material cost, it varies. You know, you could use like cheaper material, more expensive material, but typically material cost tends to go down over time. Fuel depends on geopolitical situation. Forget about trying to squeeze oil. It's just not going to happen. Land, it's already being squeezed, it's factored in. And unless you're really like able to buy tons of land and own it and defend it from people pillaging your land, you haven't formed a country. So it's unrealistic that on Reddit you're able to do it. Maybe you can organize strikes, but I don't think that's what people on Reddit want to do. They don't want, I don't see them going out into countries that where these mines are and unionizing workers. That's not really what they're trying to do. They're trying to buy silver ETFs. So if you want to increase the price, or pretty much the price of gold and silver is a little bit less dependent on the demand side. Demand side does affect it, but what affects it more is the supply side, right? The cost of mining this material on the supply side determines more than the demand. I mean, demand does, but demand for gold and silver is pretty much inflexible. It's pretty much flat. Investment demand changes it by a few percentage points, but overall demand it progresses slowly upwards, but it is not a huge, you don't see huge spikes in drops in the demand of gold and silver. It's relatively flat. And the real thing that changes the price of silver in this case is the cost of mining gold and silver. If you know that, then you do know that it's almost impossible to run a short squeeze on silver, because if you increase the buyer price, then more miners simply come on if it's cheap enough to mine. But of course, if you increase the mining side costs, then nobody will sell at a lower price because they can't. They will go out of business. And that is how you can create a short squeeze on gold and silver. But the environment to create that is almost impossible. Like, we're not talking about simply you buying a security. We're saying that you're going and sort of using a security to create a squeeze. You actually physically have to do stuff to do it. It's not a securities issue. It's you have to physically go and do something about it, and that's unrealistic. For people just who only want to operate through the internet to do it. Anyways, this is Dave. Thank you very much for watching. If you like the content, click the like button and subscribe. I'm trying to post as much as possible. This week's been quite busy for me at work. Next week I should have a bit more time, so there'll be more videos coming up. Thank you very much for watching. This is Dave. Dave out.